The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast. If you're enjoying what you're seeing here, we would really appreciate it if you would forward this podcast on to your family, your friends, your coworkers, anyone you think might appreciate this content. We'd appreciate it a great deal. Thank you.
Well, looking at the stock market, there are two significant concerns that have persisted for the last couple of years. Let's say post-COVID, once we had the post-COVID rally and then the 22 collapse, and we're back into a bull market, which the general retail public has yet to figure out.
It's
In
true.
fact, I just read an article this morning that last month set a new all-time record for money flowing into money market funds. Collectively, money market funds of the U.S. brought in over $7 trillion to capture something around a 4% return
There you go.
when the stock market this year is up 5 times that if we look at the S&P 500. But there are legitimate concerns. One of the reasons investors often stay out of the stock market when it's had a big run is because they remember when.
Yep.
Whatever the when was, it was bad. And if you do much reading, there's a high correlation between today's market and the pre-tech bubble period of the late 1990s.
Right.
There are some big differences. The 1990s tech bubble was caused by government intervention because the world was going to come to an end on December 31, midnight, 1999. The clocks would stop working, the bank vaults would be frozen closed, nuclear power plants would be uncontrollable, your security systems were going to collapse, and your computers would not start. All of which was needless fear mongering from the
None of it
government.
happened. But if you weren't around then, Don's not kidding. That was all out there. That was all. There was an imminent disaster. The world was in great peril because we didn't know how bad it was going to be, but we knew it was going to be really bad. And then, of course, it turned out to be a complete non-event. And on we went. But that's one of the problems with especially these days, getting online, listening to some blogger who's explaining in tremendous detail why there's an imminent disaster that's unavoidable. It's right around the corner. It can't be stopped. It's about to hit. And of course, buying their newsletter is the best thing you can do to get yourself in the right place to not be affected by it. But we're kind of seeing that again now. Now we're seeing it again with we've got a handful of stocks making all the gains on the S&P 500, just like the tech bubble. So we're going to get the same outcome. Everything's going to collapse. It's going to be terrible. You need to do something to protect yourself. And hence we're seeing trillions of dollars go into money market funds and missing out on huge market gains based on fear mongering that may have nothing to do with reality.
Well, the charts do look very, very similar. If you laid the charts one on top of the other, you say, well, look at that correlation. So the big run up we've had, collapse has to come after that. But as I mentioned a moment ago, there are substantial differences. Government caused the bubble in the late 90s. What government did not do is it did not trust business. Well, we have a current administration that's kind of the same thing, does not trust business, and the government's got to control it. The problem that we had in the 90s was that the test to avoid all those problems was just simply to turn your computer clock to 5 minutes before midnight on the end of the year, shut it off, turn it back on, and see what happened 5 minutes later. And voila, there was no disaster. The computers continued to work. the clocks turned over. They just didn't mark 2000. They started over at 1900. So there's a little programming error that had to be dealt with, but it was a minor deal. But in the meantime, we had a massive speculation on .com businesses that owned a website. And that's all they owned. They owned a
That was it.
URL with a website name, but they owned no business. Today, we have real businesses making real money, in fact, making a lot of money.
You bet.
This is not the same risk exposure that we had in 1999 for the next major bear market. There will be another bear market. We don't know when, but they inevitably happen because of excessive speculation. Now, that may be redundant. Excessive speculation is excessive by definition.
It is. Yes.
Those things will happen. But will they happen because President Trump's in office? Nobody knows. Will they happen because somebody happens to come up with a new technology innovation that undermines NVIDIA or
Mm,
Apple or Microsoft? I mean, all of these are particular are risks that can happen. I mean, you look at NVIDIA, which we have to thank for virtually all of the recent returns in the stock market,
you bet.
was an accident. I mean,
Completely.
they were a gaming company, and who thinks that every family in the country or the world needs to have a gaming station? Well, many do because they want them, but it's
Especially
not.
if you have a teenage boy in your house, then it's pretty much we got to have that. We got to have that setup. But NVIDIA is wildly successful in AI because they made a great chip with just an unbelievable amount of throughput, and the AI community looked at and said, "Well, that's just what we need." And NVIDIA didn't make that because they were doing all this market research. It just fell to them. They were in the right place at the right time with a great product. They have a great piece of technology, and since then they've run with it. So they didn't just sit on that. Their chips are getting faster and cheaper and more energy efficient, and every generation. So they're moving ahead as fast as they can with it also. So they didn't sit still, but they are where they are, like you said, Donna. The happy accident. It's called leading from behind. They just all of a sudden were like, oh, this is perfect for us, and it's perfect for you, by the way, Mr. AI investor, and that everybody agreed. Yep, that's what we need. And all of a sudden, they were at the top of the list.
Well, and that's the way it works for money management too. You're not exempt from this same situation. I listened to an interview of Druckenmiller. Now that is his real name. He's one of the
Right.
most successful hedge fund managers in the country, and probably in the world. And they asked him, "I said, well, you've got a big position in AI. How did that happen?" He said, "Well, I have a bunch of young bucks working for me, and they were all talking about it. And I said, what's this deal?" And so they gave me a brief introduction. I said, okay, let's take a position and do some research on it. So he said, we bought a modest position, 25%.
Right.
Modest. He said, then we started doing research, and a month later, Chat GPT came out, and the rest is history.
We
Our
look like
position,
geniuses. Yeah.
and then we added more to it. But basically, we own NVIDIA because it was luck. It wasn't because we had foresight. It was luck. Well, if you're betting on luck for your portfolio,
Yeah.
that's a hard way to retire.
Yep.
If you have a big inheritance coming your way, that's more likely, as long as you don't upset the donor that's
That's
sending
a
it
much
your
better
way.
bet. Yeah. Yeah. Yeah.
That's a better
Yeah.
bet. In the
Yeah.
meantime, what you're going to have to do is figure out how to have a disciplined approach to what you're doing. Because there are extremes in the market, and this AI bubble is one of them, and it is a bubble. It doesn't mean that it's ready to pop, but it will pop at some point in time. It'll be replaced by some other technology, or we'll finally saturate the market. Or we'll end up with the problem that we can't get enough energy to run all the data centers needed to process the AI activities. Those are all options that we simply don't know how are going to be resolved. But let's just let me put this up on the screen, Perry. You found this graph of the contribution of NVIDIA to the current earnings and the returns in the stock market.
Pretty amazing.
I mean, when you start looking back at returns, it's real easy to say, if only I should have seen that. I knew, my kid's a gamer. I should have seen that. Well,
Yep,
I didn't. And here we are. And now I'm not even in the market. I've got all my money in the money market fund, or the bulk of it. Why? Because I'm scared. Yeah, I don't like the volatility. Well, that, it comes with it. But let's just take a look at this chart on here. Most of the returns in the market have come from Nvidia and a few other tech companies. The other 495 companies are generating barely half of the return of the S&P 500. So you've got to be in a non-diversified account. Diversification is actually hurting your returns on your portfolio.
that's correct. This is one of those cases where the S&P 500 is a capped weighted index. So the largest firms get most of your investment when you invest in the S&P 500. Right now, that is to your advantage. You don't want to own a lot of the other ones, because half of the other half is actually losing money. So they're not not only are they not contributing anything, a bunch of them are actually taking the air out of your portfolio. So right now, being invested at the top, even though it's fairly concentrated position, still is a better idea because it's really easy to identify. Right now, that's where the returns are coming from. Right now, that's where you're getting the bang for your buck when you're buying the S&P 500. It's at the top, and there's going to be more of that before there's less. Like you said, Don, this was going to shake out. Every business cycle does, but there's always a huge increase at the beginning. And with AI, we're still right at the very beginning. We don't know where it's going. We don't know who the long-term winners are going to be. We don't know where the largest gains are going to be. Even right now, it's right in the basic technology of AI, which is why these tech firms are at the top end of the return cycle, because it takes a huge amount of capital to even play the AI game right now, because the infrastructure doesn't even exist, for it to be to be distributed as it will be. We don't even have the infrastructure yet, and these are the firms that are going to put that in place. So they're the ones getting the returns right now, and so there's no reason not to go along for the ride as it is. You just have to be aware this is not a permanent position. It's not going to stay that way. It's going to change like every other thing that's come along in the investment market, whether it was the internet or oil companies, or you can go all the way back to the tulip bubble way, centuries ago, and it's always the same. It comes in, it explodes, it dominates the market, then it slowly moderates or fades away.
So as we talk about the concentration issue, that's an ongoing problem. We go back. You mentioned oil. If we look at
Mm,
the S&P 500 and we go back into the 60s and the 70s, oil was the top sector. It
yep,
dominated markets, and now we have tech. Well, AI is not just technology. The real application of AI is going to be in every other sector. Companies are going to use artificial intelligence to figure out how to increase employee productivity, how to increase the productivity of the equipment that they buy and get rid of. I mean, we're going to
right.
see turnover in the equipment and the operations of firms. This is a massive change to basically reset the way that business works and provides product and services to consumers. This will be a product enhancement that we will continue to see develop over the next decade, maybe two. I argue that we're actually in a new bull market, like the bull market that started in the 80s with Ronald Reagan and his tax cuts and deregulation that he put in place back in the early 80s. And we've had some corrections. We've washed out some stuff. We've had industry turnover, and we are on the beginning of a new long-term improvement in our economy and the way products and services are developed. And yet retail investors have yet to find out that this is really what's going on. Now, fear not, they will figure it out. Fear of
They will.
missing out does happen.
Yep.
It's happened recently with um, Bitcoin. We've had speculation all over in the last couple of weeks.
Yep.
That's not done. That has to be worked out through the global economy. That will get better, and it will have better services and application as time goes by. AI is going to be the same kind of thing as it spreads its benefits to the community, to through the business world. We'll see it popping up in something that we don't realize. AI is behind this new benefit product or service. And
It's
yet, if
coming
you
fast. Yep. And it's going to
talk,
be interesting because this is a white collar revolution. AI is going to first be initiated in white collar jobs, which is instead of Henry Ford when he came in and invented the assembly line, it was the laborers whose jobs changed. Now it's going to be the other end. This is going to be a white collar revolution in the beginning, and so it's going to be very interesting to see how that plays out and where that actually falls in line with the huge changes. All those white collar jobs aren't going away, but they're going to be changed significantly. So that's going to be the definition of who's going to win, who plays those changes best.
thanks for being with us today. If you like what you heard, found it interesting, we assume some of your friends, family probably be interested in it too. We'd appreciate it if you would share the link, let them know. If you want to get an update on where the stock market is as we start into December, the first Saturday of every month, we do a stock market webinar. The stock market, or the shortcut to our website, is based on our old radio show. It's iriradio.com. Go there, a couple of clicks, you can sign up for the webinar. If you can't attend, as long as you're registered, we'll send you a link. You can watch it on your own time. Down below is a button to subscribe to our podcast. We appreciate if you do that. Pass it on to your friends and coworkers. Have a great day. Look forward to our next communication.